In finance, one of the most fundamental questions we try to answer is this: what actually determines the return of a stock? At first glance, many students assume that stock prices move randomly or are driven purely by market trends. But when we study financial theory more closely, we realize that returns are not random at all. They are influenced by underlying economic forces. Traditionally, one of the most widely taught models in finance is the capital asset pricing model, or CAPM. While this model is elegant and easy to understand, it simplifies reality to a point where it may no longer be sufficient. This brings us to the central idea of this lecture: multi-factor models of risk and return, a new way to understand markets. To fully appreciate the importance of multi-factor models, we must first understand the limitations of the capital asset pricing model. CAPM states that the expected return of an asset is equal to the risk-free rate plus a risk premium based on its sensitivity to the market. In simple terms, beta tells us how much a stock moves with the market. A higher beta means more volatility, while a lower beta means more stability. But this framework relies on one critical assumption: that market risk is the only source of systematic risk. In reality, investors face many risks. Inflation, interest rates, and economic growth all shape returns. These limitations led researchers to develop better models, introducing multiple sources of risk, and giving rise to theories like the Arbitrage Pricing Theory. The Arbitrage Pricing Theory, or APT, is a flexible alternative to CAPM, developed by Stephen Ross. It explains asset returns through exposure to multiple common risk factors, not just one. Developed by Stephen Ross in the 1970s, APT is based on the idea that returns are driven by multiple common risk factors. Unlike CAPM, which relies on a single market factor, APT allows multiple factors to influence returns, capturing real-world complexity. At the heart of APT lies arbitrage, the ability to exploit price differences and earn profit without taking additional risk. As arbitrage opportunities are exploited, prices adjust and move back toward their true value, aligning with underlying risk. APT does not limit us to fixed factors. It adapts to real-world data, making it a powerful tool for understanding how multiple risks shape asset returns. To understand arbitrage pricing theory at a deeper level, we must focus on its structure and how it models expected returns. Unlike CAPM, which uses a single beta, APT assumes that each asset is influenced by multiple sources of systematic risk. Each factor has two key components: a sensitivity measure called beta and a corresponding risk premium. Expected return can be understood as the risk-free rate plus the sum of all factor sensitivities multiplied by their respective premiums. If a stock is sensitive to inflation, its return increases with inflation. But if it reacts negatively to interest rates, rising rates can reduce its expected return. APT is powerful because it adapts to real-world conditions, but this flexibility also makes identifying the right factors a complex challenge. Now that we understand the structure of APT, the next step is to interpret what these risk factors actually represent in real economic terms. In practice, these factors are linked to macroeconomic conditions that influence business performance and investor expectations. Inflation is a key factor. It reduces purchasing power, increases costs, and impacts the real value of future cash flows. Interest rates influence borrowing costs and valuation. Higher rates reduce the present value of future earnings. Economic growth leads to higher earnings and stronger investor confidence, supporting higher stock returns. Each factor represents a risk that cannot be diversified away, which is why investors demand a risk premium for bearing it. To make these concepts more concrete, let's consider a simple example based on inflation and economic growth. Each factor carries a risk premium, reflecting how much return investors demand for exposure to inflation and economic growth. Stock X may respond more to economic growth, while stock Y is more sensitive to inflation changes. Expected returns are calculated by combining the risk-free rate with factor contributions, weighted by their sensitivities. This shows a key insight. Risk is not one-dimensional. We must understand the type of risk, not just its level. With APT, investors can align their portfolios with economic expectations, choosing assets based on how they respond to different factors. At the heart of arbitrage pricing theory lies one powerful concept: arbitrage.
Arbitrage means earning profit without risk and without requiring any net investment.
Markets are not always perfect. Sometimes prices do not reflect true underlying risk. Investors exploit mispricing by selling overpriced assets and buying combinations that replicate the same risk at a lower cost.
As more investors act, prices adjust, mispricing disappears, and markets move back toward equilibrium.
Arbitrage does not require predicting the future. It relies on rational behavior and competition to eliminate pricing errors. Let's make arbitrage more concrete by considering an example with inflation and economic growth as key risk factors. Each stock has different sensitivities to inflation and growth, which determines its expected return under APT. If a stock's return does not match what APT predicts, it becomes mispriced. It may be overpriced or underpriced. Investors exploit this by shorting the overpriced stock and taking long positions in other assets with similar risk exposure. If constructed correctly, the portfolio requires no net investment, carries no systematic risk, yet generates profit. As more investors exploit the opportunity, prices adjust, mispricing disappears, and markets return to equilibrium. While APT is theoretically powerful, the real question is whether it works in practice. One of the most influential studies was conducted by Roll and Ross, who tested APT using large sets of historical data. In the first step, researchers estimated factor sensitivities, or betas, using time series data. In the second step, they tested whether differences in returns could be explained by these factor sensitivities. Their findings showed that multiple systematic factors, not just the market, are needed to explain stock returns. However, APT does not specify exactly which factors to use, leading to differences across studies. Although APT is powerful and flexible, it is not without its limitations. Unlike CAPM, APT does not tell us which factors to use. This creates a major challenge for investors and researchers. APT assumes arbitrage works perfectly, but real markets have transaction costs, information gaps, and behavioral biases. APT assumes a linear relationship between factors and returns, but real markets can behave in more complex ways. Despite its limitations, APT laid the foundation for modern multifactor models. Models like Fama, French, and Barra build on APT, bringing us closer to real-world investment analysis. After understanding APT, we now move toward more structured and practical multi-factor models. APT does not specify which factors to use, leaving researchers to identify them empirically. Multi-factor models rely on empirical evidence, identifying factors that actually explain stock returns. These models are widely used for portfolio management, asset allocation, and risk analysis. Different types of stocks respond differently to economic conditions, making multiple factors essential. Next, we explore one of the most influential models, the Fama-French three-factor model. The Fama-French model extended CAPM by adding new factors to better explain stock returns. Researchers found that some stocks consistently earned higher returns than CAPM could explain. The size factor shows that small-cap stocks tend to outperform large-cap stocks over time. The value factor shows that high book-to-market stocks outperform growth stocks. The model explains returns using three factors: market risk, size, and value. The Fama-French model provides a more complete explanation of stock returns, making it a cornerstone of modern finance. Beyond models like Fama-French, another major class of multi-factor models focuses on macroeconomic variables that directly connect broad economic change to asset returns. Financial markets are deeply connected to the real economy. Macroeconomic shifts can reshape earnings, sentiment, and valuation. When inflation rises unexpectedly, companies face higher input costs, weaker real cash flows, and lower profitability, which can quickly put downward pressure on stock prices.
Interest rates matter because they raise borrowing costs and change discount rates, which lowers the present value of future earnings and affects investment decisions.
Macroeconomic models are especially useful because they capture how recessions, policy changes, and shifts in economic growth can reshape financial markets from the outside in. Even though macro variables can be hard to measure and are often revised, these models still provide valuable insight into how economic conditions shape asset prices. Moving into advanced applications, the Barra model is widely used by institutional investors to analyze returns, manage risk, and optimize portfolios in real markets. Unlike simpler models, Barra includes a wide range of factors such as size, value, momentum, volatility, liquidity, and industry-specific variables. One key strength of Barra is its ability to break down portfolio risk into components, helping investors understand exactly where their exposures originate. This allows portfolio managers to actively control exposures, whether to interest rate risk, market volatility, or specific industries. The Barra model relies on advanced statistical techniques and large datasets, making it highly precise but also more complex than simpler models. Barra represents the real-world application of multi-factor theory, transforming academic ideas into powerful tools used in professional investment management. To fully understand asset pricing, we must compare these models and see how each builds on the previous one. CAPM is the single-factor foundation. APT expands to multiple risks. Fama-French CAPM provides a simple and intuitive framework, but it ignores multiple sources of risk present in real financial markets. APT introduces multiple factors but does not specify which ones to use, leaving a gap between theory and application. Fama-French improves the model by adding size and value factors, offering a more accurate explanation of stock returns. Macroeconomic models focus on how external economic conditions like inflation and growth influence financial markets. Together, these models form a hierarchy, giving us a deeper and more complete understanding of risk and return in financial markets. Multifactor models are not just theoretical concepts. They are actively used by portfolio managers and institutional investors to make better investment decisions. Instead of relying on a single measure like market beta, investors use multiple factors to generate more accurate and comprehensive return estimates. By incorporating company size, valuation metrics, and macroeconomic indicators, investors gain deeper insight into the true sources of risk and return. Multi-factor models allow investors to break total portfolio risk into components like market risk, interest rate risk, and sector-specific exposure. By comparing actual returns with model predictions, investors can identify whether performance comes from true skill or simple exposure to risk factors. Overall, multi-factor models provide a powerful framework that helps investors analyze markets, manage risk, and make smarter, more informed investment decisions. As we conclude, remember that financial markets are complex systems influenced by multiple economic forces, and no single model can fully capture this reality. Multi-factor models teach us that returns are not random, but are driven by identifiable economic factors that can be analyzed and understood. For students and future professionals, mastering these concepts is essential because they form the foundation of modern investment analysis and portfolio management. At the same time, always remember that models are simplifications of reality, and they must be used with critical thinking and awareness of their limitations. As you move forward, connect these concepts with real-world economic changes and market trends to develop strong financial intuition. Keep learning, keep questioning, and keep exploring the fascinating world of finance, because the deeper you understand it, the more powerful your decisions become.